Hi, this is Professor Cabrini, and I just wanted to go over a problem with you guys. Chapter 14, Problem 14-1A from Problem Set A. In your textbook, it is page 563. In this problem, we'll be able to review a few of the concepts that we covered in Chapter 14. And so I just want to make sure that you guys get some kind of explanation aside from the material that the text provides that I can go over with you guys. So, without any further ado, the problem here wants us to look at each of these costs and then classify them. So we need to be able to classify them as either variable or fixed, and whether they're product or period costs. And then we want to compute the manufacturing cost per drum, which will be part 2. And then we have some analysis that we're going to perform. So first, let's run through each of these costs. All right. So we're manufacturing drum sets. That's what this company does. And so first we've got plastic for the casing on the drums, and the total cost for that was $17,000. So is this a variable or fixed cost? Well, since this is going to be used in the production of the drums, the amount of plastic that we need is going to vary depending on how many drums we produce, and therefore it's going to be a variable cost. Okay, is this a product or a period cost? Well, since it is plastic for the casing, so it's specifically for the drum, it's going to be a product cost. Okay, what about wages for assembly workers? Again, this cost is the direct labor for the production of the drums. So therefore, the amount of money spent on assembly workers is going to vary with the production quantity of the drums. And so therefore, the $82,000 in cost is going to be variable. And it's also, again, going to be product because it's tied directly to the product itself. Now, what about property taxes on the factory? Well, this is a manufacturing cost, but is it going to vary with production? Well, no, it won't. So it is definitely a fixed cost. And is it a product or period cost? Well, the property tax is tied to the building and not to the drums. And therefore, it's an annual expense, and so it's tied to the period instead. You kind of have to look at these costs and decide what the nature of the cost is. You almost have to quiz yourself. Accounting staff salaries, $35,000, okay? Accounting staff salaries, would this be variable or fixed? Well, this is a staffing function. It's part of the underlying foundational services that the company has to have in some way, shape, or form all year round. So this isn't really going to vary much. They're going to have accountants, they're going to pay them every week, and it's not going to matter how many drums they manufacture or sell. So all $35,000 of that is going to be a fixed cost. And again, it's not tied directly to the product itself. This is something that they're going to incur over time. And so it is a period cost, a cost of the period. Now, drum stands, they've given you a little bit more information here in this particular problem. They tell you that they purchased 1,000 drum stands, but that still doesn't change the nature of the cost, because the manufacturing cost is going to be the cost put into the drums itself. And so the number of drum stands used is going to vary with the number of drums produced, and so it will be a variable cost. And again, since it's used in the product itself, in the final product, it's going to be a product cost. Now, the rent cost of equipment for sales staff, think about it again. Similar to the property taxes and the accounting staff salaries, this cost isn't going to vary with the production or sales. And so therefore, it's going to be a fixed cost. So that $10,000 will be listed as fixed. And is it a product cost or a period cost? Well, rental of the equipment isn't going to have anything to do with the product itself. This isn't a cost that's going to directly impact the product, and so therefore it's a period cost. It's incurred over time. Upper management salaries, same difference as, say, the accounting staff salaries. It doesn't matter. They're going to get paid, okay, regardless of how many drums. So it is fixed and it is period. Okay, now let's take a look at the number 8, the annual flat fee paid for factory maintenance services. Well, they say it's a flat fee, so that should tell you right there. It is fixed in nature. And is it a product or a period cost? Well, this is interesting, okay? Some people might try to say, well, this is a period cost, okay, because it says annual flat fee. But it's maintenance service, okay? And so it's a flat fee paid for maintenance service. And so we can directly tie that to the product, okay? Because this is maintenance that's going, the amount of maintenance that's performed, right? It will vary itself based on the amount of product that's produced. So it must be tied to the product. But since they're paying a flat fee, it's fixed in nature, but it is tied directly to the product. So yes, a few of these can be kind of tricky. You kind of have to think your way through them a little bit. And believe me, sometimes I come across ones that I won't necessarily agree with. And also, when you get a job and you're doing cost accounting, a lot of it depends on who your employer is. Because sometimes the employer, I had a student that got a job one time at a company, and he called me up and we had a long conversation about classification of costs because they were doing it differently than we learned in class. And I told him, I said, you know, we learned a particular methodology, but the first thing we discuss in cost accounting is that there's no generally accepted accounting principles for cost accounting. All of this is based on internal definitions. And so the company management will decide how they want to do this. So some of how these costs are defined are going to be a reflection of what management decides to do. The key is we'll get into this in parts 3 and 4, which are more of the analysis. What's the difference between variable and fixed, product and period, in terms of managing costs? That's where the question comes in. So number 9, sales commissions. It is $15 per unit. So this is going to be based on the units sold. So it is a variable cost, but it's based on the number of units that are sold. And it is a period cost because it's not associated with the manufacture of the product. It's to the sales. So it's that selling expense that's part of operating costs. And so it's not directly tied to the product. And then we have depreciation straight line on machinery, and that is going to be fixed because the machines are there. They'll be depreciated whether they're in use or not. And that is also a period cost, not a product cost. Okay? So those are our 10 costs, and that's how they line up. Now, the second part of this is they wanted you to compute the manufacturing cost per drum. And so how will we do that? Well, we'll go to part 2 here, and I've set up a spreadsheet where we can kind of enter things as variable or fixed, and if they're production costs. Now again, these are production costs. Not all of the costs that we looked at before were production costs. We want only the product production costs here. So what were the variable costs that we identified? We identified the plastic for casing, the wages of the assembly workers, and the drum stands. Those were the major variable costs that we were able to tie directly to this product. And so that was the $17,000 for the drum casing plastic, $82,000 for the assembly wages, and $26,000 for the drum stands. And so I'm going to use my auto sum function here. And so we've got a total of $125,000, and I'm just going to underline it. You want to make it easy on somebody to read it. And so how do we determine the unit cost? Well, in this case, they're telling us it's 1,000 units. And so all you're going to do is you can set up a quick little formula here. And so you could take that divided by 1,000. Whoops. There we go. There. Okay, that's better. And so it is $17 per unit. And so we can just carry this down. And I'll put an underline under it. And so that is our variable cost per unit. Now, what were our fixed costs, fixed production costs? Well, again, you run down the fixed and you want the product cost. So if it's in fixed and it's in product, it's going to be included here. So the $5,000 in factory on property taxes, the annual maintenance fee for $10,000, and then the depreciation for $40,000. And we use the auto sum feature again. Click 55,000. I'm going to put another underline there. And we can calculate a unit cost on this, but the significance of the unit cost between variable and fixed costs is going to be a little bit different. And we'll see that in a second. Let's see. So we're going to divide that by 1,000. And we get $5 per unit, $5 per unit. All the way down. And underline. Okay, and our total production costs is the sum of that variable cost plus the sum of the fixed production costs. So we have 180,000. And there we go. And I'm going to double underline those for emphasis. Okay? I'll single underline these. Again, presentation is important. You want people to understand what it is you're showing them. So those are the way the costs lay out. And so again, we went through, and for part one of the problem, we went through each cost and decided, is it variable or is it fixed? And then we asked the question, is it product or is it period? And again, most of them are clear cut, but you can have a few that may present some problems for you. So the one here that I thought was the most difficult one to deal with was number 8, the annual flat fee paid for factory maintenance service. That maintenance service is a product cost because it is tied to the manufacture of the product. The more products that are manufactured, the more the machinery is going to be used, the more maintenance that's going to be used. However, they're paying a flat fee for it, so it's a fixed cost. So it's a product cost that's a fixed cost. Now, if they were going to pay a per hour maintenance fee, that would vary. And so you would see that become a variable cost. So here it's a flat fee, so it's fixed, but it's still product. It doesn't change the fact that it's tied to the product. Okay? And the other one that could potentially fool people is sales commissions, because it shows as a $15 per unit. And so some might say, well, it's variable, so it must be product. In this case, no, it's not product. It's period cost. So you can have period costs that are variable, and you can have product costs that are fixed. Okay? So, and you can organize in terms of figuring out what your production costs are. You want to find those items that are tied directly to the product. The other costs are operating expenses that will show up below the manufacturing costs. Okay? So now, what do we have for the last two parts, part 3 and part 4? Part 3 states, and again, if you're following along, you should be, page 563 in the text. And this is the problem 14-1A that's on the bottom half of that page. And so number 3 says, assume that 1,200 drum sets are produced in the next year. What do you predict will be the total cost of plastic for the casings and the per unit cost of the plastic for the casings? Okay? And so what do we think if we went from 1,000 to 1,200? What would happen? Okay? Well, would our costs change? Well, yes, they certainly would change. First of all, it's a per unit cost. It's a variable cost. So that means it's going to vary with production. And so if we were to go here and say, okay, now we're going to deal with 1,200 units instead of 1,000. Okay, well actually what I want to do here is let's do here. So we're going to have 1,200 units, okay, instead of 1,000. Open that up a little bit. I don't know why, but I just, my OCD kicks in and I just have to straighten things. Alright, so we have 1,200 units. And so what we could do is we could say, well, this is going to equal this times, well, that's not a number, so let's put it here. Oops. Hold on a second, let me back up. It's just a matter of entering it. 1,200, so I'm going to have 1,200 there because that's what I want to use, equals 17 times 1,200, and I will format it as currency. There we go. So it is $20,400 because, again, it's a variable cost, and so it's going to vary. And let's see, and the per unit cost. Is the per unit cost going to change? No, it's not going to change. And you'll learn about something, if it hasn't already been mentioned in the text, you'll be learning something about the relevant range. So as long as we're operating in the relevant range, that variable cost isn't going to change. So if you negotiated a certain price for this plastic for the casing, and you're going to use X amount of it, that cost per unit won't change. Variable costs per unit don't change with changes in volume. Okay? The total variable costs will change with volume, as we can see here, but the unit cost doesn't. And again, you can prove that to yourself by just simply dividing the total cost by 1,200, the new production value, and you still have 17. So it's still the same. Doesn't matter. Okay, that's part 3. Part 4 says, assume that 1,200 drum sets are produced in the next year. What do you predict will be the total cost of property taxes and the cost per unit of property taxes? Well, if they're not going to do anything to the factory that would cause property taxes to go up, the only thing that would increase property taxes is an increase in the property tax rate. But that has nothing to do with the production of drums. And so assuming that the property taxes don't change, then it's still going to be $5,000. Okay? Doesn't matter. Still going to be, I'm going to set it as currency. Okay? And what's going to happen with the units? Well, let's check it out here and see. So we're going to divide the 5,000 divided by 1,200 units. And lo and behold, it went from $5 per unit to $4.17 per unit. So we learned something critical about the behavior of variable costs and fixed costs relative to changes in volume. With variable costs, a change in volume, the unit cost does not change, but the total cost will. So if it's a variable cost item, the total cost of that item will vary, but the unit cost for that item will not. If it's a fixed production cost, the total fixed production cost won't change, but the per unit amount will. And that makes sense. If it's fixed, but the denominator, think about it, because what changed here is our denominator. Our denominator went from 1,000 to 1,200. So you're dividing a bigger number into the same number. So then the per unit amount is going to decrease. With variable cost, okay, the numerator went up with the denominator. So that the total cost, okay, the total cost went up with the production volume increase, and so the per unit amount stays constant. So that $17 stays exactly the same. All right, so that's kind of the behavior of these things. And remember, the issue with prime and conversion costs, some folks did ask about that in the video, and I tried to review that in the narrated PowerPoint slide that I posted. And so the critical piece there is just to remember, that your prime costs are your direct costs, direct material, direct labor, and your conversion costs is direct labor and manufacturing overhead. Okay? You just memorize that, remember it, eventually it'll become kind of second nature to you. And so that's the deal with classification of costs. So if you guys want me to go over any of the other problems, you individually can email me and let me know. I'd be more than happy to do that. I can do something similar to what I did here. And also, again, I can meet with you individually or in groups. We can schedule a team session, and I can go over whatever problem you want me to go over with you. I'm more than happy to do that. All right. Well, thanks very much.